Welcome, everyone. Today, we are diving into a fascinating tool that could change the way you understand market trends. It is called a range chart. We will explore what range charts are, how they work, and how you can use them to get better at trading. Stick around because by the end of our time together, you will have a solid grasp on these charts and be ready to use them effectively. So let us get started. Have you ever found yourself staring at a chart, trying to make sense of all the noise and wondering if there was a clearer way to understand price movements? Well, let me introduce you to range charts, a tool that could change the way you see market trends altogether. Now, you may be familiar with charts that show price movements over a set period of time. You know, the kind where each bar or candle represents a minute, an hour, or a day. Range charts work differently from those charts. They do not care about time at all. Instead, each new bar forms when the price moves by a certain amount. If the price does not move enough, no new bar will show up. This makes range charts great for focusing purely on price action. Range charts also help you spot classic chart patterns more effectively. Patterns like double tops, double bottoms, and head and shoulders can often become clearer on range charts. Since range charts filter out all the small, meaningless price movements, these patterns tend to stand out, making it easier for you to act on them. For example, if you are watching for a double top pattern, range charts make the two peaks more distinct, so you know when a potential reversal is happening. Likewise, flags and pennants, which often signal a continuation of a trend, are easier to identify since the price action is smoothed out. Another useful pattern that shows up well on range charts is the wedge pattern. Whether you are looking at a rising wedge or a falling wedge, range charts make these consolidations much more noticeable. When the price breaks out of a wedge, it often signals a significant move, and range charts can help you spot these breakouts more clearly. Triangles, such as ascending or descending triangles, also become easier to recognize since the chart is only printing bars when the price moves significantly, reducing the clutter you would see on a time-based chart. Imagine that. You are looking at a chart that does not change just because another minute goes by. It changes only when something meaningful happens. When you are trying to follow trends or understand market activity, this can be a game changer. Let us see how this works in more detail. In a range chart, every bar or candle represents a specific price range. For instance, if you set a range of $1, then every time the price moves up or down by $1, a new bar forms. Simple, right? Let us say you are looking at a stock that is priced at $50. If that stock moves up from $50 to $51, a new bar will appear. But if it only moves 50 cents, no new bar will form. This can be really useful for highlighting when the market is active and filtering out the times when nothing much is happening. Range charts are particularly helpful for identifying various chart patterns more effectively. Patterns such as double tops and double bottoms become more visible as each significant price movement creates a bar, allowing you to easily spot these formations. The head and shoulders pattern, which signals a potential reversal, is also easier to detect as the price movements are displayed without unnecessary clutter. You will often find that triangles, including ascending, descending, and symmetrical triangles, are clearly highlighted on a range chart, helping you anticipate potential breakouts as price moves beyond these consolidation levels. In addition to these classic formations, range charts also make other significant patterns easier to spot. For example, the cup and handle pattern, which is often indicative of a continuation after a period of consolidation, stands out more clearly with the reduced noise that range charts offer. The rounded bottom or saucer pattern, signaling a slow shift from bearish to bullish sentiment, becomes more distinct when using range charts, allowing you to see the gradual change in market behavior. Range charts also enhance the visibility of continuation patterns such as flags, pennants, and channels. Flags and pennants, which often represent a brief consolidation before the continuation of the prevailing trend, appear more organized, making it easier to plan your entries and exits. Channels, whether ascending or descending, can be more effectively outlined as range charts filter out the smaller fluctuations that can often distract from the larger trend boundaries. Furthermore, you can more easily identify complex patterns like double or triple tops and bottoms. These patterns, which indicate multiple failed attempts to break through a resistance or support level, are much easier to validate with range charts as the key price points and reactions are clearly defined. Being able to see these price reactions without the clutter of minor movements gives you the confidence to identify strong levels where the market is likely to turn. Wedge patterns, both rising and falling, are another formation that becomes clearer with range charts. These consolidations often lead to significant breakouts, and range charts make it easier to see the tightening price action that signals an impending breakout. You will also find that rectangles or box patterns, which signify a period of price consolidation before a breakout, become highly evident on range charts, allowing you to prepare for a strong movement once the price breaks out of the established range. Finally, harmonic patterns like Gartley, butterfly, and bat patterns can also be easier to discern on range charts because they require precise price swings for confirmation. By removing the smaller, insignificant movements, range charts help make the completion of these complex geometric structures more noticeable, giving you a better opportunity to act on them effectively. You can also identify flags and pennants more accurately with range charts. These continuation patterns, which signal a brief pause before the trend resumes, stand out more clearly when the noise is filtered out. Similarly, wedge patterns, whether rising or falling, become easier to recognize, helping you to spot potential trend reversal points. Rounded tops and rounded bottoms, which indicate a gradual shift in market sentiment, can also be seen with more clarity. Another pattern that becomes more apparent with range charts is the rectangle or consolidation range. When the price moves within a certain range for an extended period, range charts help you see the clear boundaries of this consolidation. When the price finally breaks out of the rectangle, it often signals a strong movement, and the range chart makes this breakout much more distinct. Understanding these patterns and recognizing them on a range chart can be a powerful tool to improve your decision-making process as a trader. Have you ever looked at a chart and wondered, is anything actually happening here, or am I just watching random small moves? This is where range charts can help. They show you significant price movements and ignore all the small stuff. This means they eliminate a lot of the noise that you might see in time-based charts. You will get to see trends more clearly, and it becomes easier to spot when something important is happening, like a breakout or a reversal. Now let us talk about how you can set up a range chart for yourself. One of the most important decisions you need to make is choosing the right range size. If you set the range too small, you will end up with a lot of bars and the chart will look crowded. It might even be hard to make sense of it all. But if you set the range too large, you might miss some important moves. The key is to find the right balance for the asset you are trading. For a stock that usually moves in small amounts, a smaller range like 50 cents might work well. But for a more volatile stock, you might choose a range of $5 or more to capture the bigger moves. It is all about adjusting the range so that it fits what you are trading. When choosing the range size, it is also helpful to consider the different chart patterns you are trying to identify. For example, if you are looking to spot flag patterns or pennants, a smaller range might be more suitable to capture the frequent price movements that form these patterns. Conversely, for patterns like head and shoulders or double tops, you might want a larger range to ensure the chart is not cluttered with too many bars, allowing these major formations to stand out more clearly. Additionally, think about the typical behavior of the asset. Does it often experience sharp spikes and dips, or is it more stable? For assets that have frequent, rapid price changes, a smaller range will help capture those details, making it easier to spot reversal signals. On the other hand, if the asset tends to move in a smoother trend, a larger range will help you focus on the bigger picture without being distracted by smaller fluctuations. Remember that range size will also influence your ability to recognize key support and resistance levels. If the range is too small, the chart may show too many price points, making it difficult to identify clear levels of support or resistance. By experimenting with different range sizes, you will be able to strike the perfect balance that makes these levels and the patterns around them more evident. Take your time to adjust and fine-tune your range settings until the patterns you are looking for become visible and actionable. Once you have your range chart set up, you will start noticing some patterns. Range charts are great for drawing trend lines because they get rid of the small, unnecessary price movements. Trends become clearer, and it becomes easier to spot when the price is breaking out of a pattern or reversing direction. Have you ever tried to draw trend lines on a time-based chart only to get confused by all the small bumps along the way? Range charts help solve that problem. Look closely at support and resistance levels on range charts. These levels are often much easier to see because the focus is only on price action. When you see the price approach a support or resistance level, you can look for potential reversals or breakouts. Have you ever spotted a level where the price seems to bounce back and forth and wondered if that was a good place to enter a trade? Range charts help make those levels even clearer, which can make your trading decisions easier. Now, range charts are not just useful for one type of trader. They can work for all different styles, making them incredibly versatile. If you are a day trader, range charts can be a great way to avoid those boring periods when nothing much is happening. You can focus only on the times when the price is actually moving, helping you make more precise and timely trading decisions. You can also use range charts to better identify chart patterns like flags, pennants, and breakouts, which can indicate strong moves during active trading periods. For swing traders, range charts are incredibly useful for spotting those longer-term trends. By eliminating the small price fluctuations that do not matter, range charts help you stay focused on the key trend direction. You can identify reversal patterns, such as head and shoulders or double tops, with more clarity, allowing you to act confidently when major shifts in market sentiment occur. Swing traders can also benefit from using range charts to find strong support and resistance levels, which are clearer because the chart removes unnecessary price action. If you are a scalper, range charts are perfect for catching quick entry and exit points when the market is moving rapidly. Scalpers can take advantage of range charts to see every meaningful price move, allowing them to enter trades precisely when opportunities arise. patterns like small flags or even micro trends become more visible, and these can provide you with multiple chances to take profits throughout the trading session. Since range charts only print when the price moves, they give you an accurate representation of volatility, making it easier to decide when to jump in or stay out. Range charts can also help position traders who are looking at the bigger picture. By focusing only on significant moves, these charts filter out all of the intraday noise, allowing position traders to see clear, long-term trends. Patterns like rising and falling wedges, as well as larger triangle formations, are easier to identify, giving a strong indication of when a trend continuation or reversal is likely to occur. Think about which type of trading fits you best and imagine how a range chart could make your strategy simpler and more effective. Whether you are looking for intraday opportunities, planning to hold positions for several days, or just trying to understand long-term market trends, range charts provide a level of clarity that can improve your decision-making process. Let us compare range charts to time-based charts for a minute. With a time-based chart, every bar forms after a certain amount of time has passed, whether it is 1 minute or 1 day. That means you could have several bars forming even when there is no real movement in price. Range charts are different because they form only when the price moves by the amount you have set. This means they are less noisy and give you a clearer picture of the real price action. Some traders like time-based charts because they provide a steady rhythm. But if you want to focus on price movement and ignore what time it is, range charts are a great choice. It is not that one chart is better than the other. It just depends on what you want to focus on. Of course, there are some mistakes you should avoid when using range charts. One big mistake is choosing the wrong range size. If your range is too small, your chart will be full of bars, and it will be hard to see any real trends. On the other hand, if your range is too large, you might miss out on important price changes. Another mistake is ignoring the volatility of the asset you are trading. You need to match your range size to how much the price of that asset usually moves. And do not make the mistake of overanalyzing every little move you see. It is important to focus on the bigger picture and avoid getting caught up in every small change. If you want to make the most out of range charts, it is a good idea to combine them with other indicators. You can use a moving average to help confirm a trend. If the price stays above the moving average on your range chart, that could mean the trend is going up. Similarly, if the price is below the moving average, it could indicate a downward trend. Moving averages can help you smooth out price movements and give you a clearer picture of the overall direction. Another useful indicator is the relative strength index, which can help you see if an asset is overbought or oversold. An RSI reading above 70 typically indicates that an asset is overbought and could be due for a pullback, while an RSI below 30 suggests that the asset may be oversold and could be set for a bounce. When used with range charts, the RSI can provide additional confirmation for price reversals, helping you decide when it might be time to enter or exit a trade. Volume indicators are also essential when using range charts. They show whether the price movement is backed by strong buying or selling pressure. For example, if you see a breakout on your range chart, checking the volume can help you determine if the move is strong and likely to continue. High volume during a breakout suggests a higher likelihood of a sustained move, while low volume could mean that the breakout might not have enough strength to continue. Another powerful tool is the Bollinger Bands indicator, which helps you understand volatility. Bollinger Bands create a channel around price movements, based on standard deviation. When the price touches or moves outside the upper or lower bands, it may indicate that the price is overextended. When used with range charts, Bollinger Bands can help highlight when the market is particularly volatile or when it might be about to reverse. You can also consider using the Moving Average Convergence Divergence (MACD) indicator. MACD is particularly effective for identifying changes in momentum. It shows the relationship between two moving averages of an asset's price, and when the MACD line crosses above or below the signal line, it can indicate potential buy or sell opportunities. On range charts, MACD can help confirm the strength of a trend and assist in identifying entry and exit points. If you are just looking at the range chart by itself, you might miss some of these extra clues. Combining indicators like moving averages, RSI, volume, Bollinger Bands, and MACD helps give you a more complete picture. Each indicator adds a different layer of insight, making your analysis more robust and helping you make more informed trading decisions. Here are a few practical tips to help you get started with range charts. First, start simple. Choose a range size that fits the usual volatility of the asset you are trading. As you get more comfortable, you can experiment with different range sizes to see what works best for you. Second, pay close attention to breakouts. When the price breaks through a support or resistance level on a range chart, that could be a strong signal that something important is happening. These breakouts can offer some great trading opportunities. Finally, do not rely only on range charts. Use them alongside other tools and charts to get a more complete view of the market. Let us take a moment to recap what we have learned so far. Range charts are all about price movement. They do not care about time. They are great for filtering out noise, making trends clearer, and helping you see key support and resistance levels. By focusing only on important price changes, range charts make it easier to see what is really happening in the market. We also discussed how different chart patterns become more noticeable on range charts, such as double tops, double bottoms, head and shoulders, wedges, triangles, flags, and pennants. Understanding these patterns allows you to predict potential breakouts, reversals, or continuations, making your trading decisions more informed. If you are just getting started, set a range that makes sense for the volatility of the asset you are trading, and then start experimenting. Add in some other indicators to help confirm what you are seeing, such as moving averages, RSI, volume indicators, Bollinger Bands, or MACD. These indicators provide further insights into price trends and momentum. Be sure to use range charts alongside time-based charts to get a fuller understanding and to maximize your analysis capabilities. Range charts are a powerful tool that can help you see the market more clearly and make better decisions. If you have been wanting to focus more on price action without getting distracted by all the noise, give range charts a try. With some practice, they can become an important part of your trading strategy. Keep exploring, keep learning, and keep asking questions. Let us keep pushing ourselves to see the market in new ways and get better every day. Remember, understanding the tools at your disposal can make a big difference, and range charts might just be the tool you need to take your trading to the next level.